So when the Fed started to inject liquidity into the market of the extent of, it's like countless trillions, we immediately saw, all right, so the fall is over. Now there is a floor to equity prices, and now you're going to see a very, very strong and sustained rally, even without economic fundamentals having improved. So whether it is in the US, whether it is in China, whether it is in Europe, where we all own stocks in our fund, in our portfolio, or in India, the stock market rally does not mean that the real economy is also rallying. All it means is the cost of money has come down to such a large extent that equities relatively have become more attractive. And when equities become more attractive without economic fundamentals, or in fact, because of the fact that you have cheap money, you will still get a big rally in equity markets, even without economic fundamentals, GDP growth, all those things really looking very positive. It will be true for US, China, Europe, India, where we are going to see an equity market rally, but there will be no real economic growth supporting the rally because it will be driven by just low cost money. But we are investors, all right? We are in the business to make money. We are not in the business to look at economic data and say things are very bad and hence we should not hang on. We are not in the business of just looking at economic data and telling ourselves things are very bad and we will not invest. Not at all. Economic data is one part of the analysis, but that is not the entire analysis. In our investing models, and we follow a very, very deep data science driven model. Ours is not the traditional style of going, meeting a company, oh, acha lagta hai company, we'll go and meet a supplier. That's all outdated. We use data. 80% of our investing comes out of data. 20% is our own 30 years of human intelligence. When you marry data science with human intelligence, what you get is an investing model which is very, very robust. Our models told us, look, economic fundamentals are terrible, but that doesn't mean stock market will fall. It will follow the trend of cheap money. That is what has happened. That is what has driven the global market rally. That is also what is driving the Indian market rally. Also, let me point out, India is not the only market that has rallied, by the way. Every market in the world has rallied. In fact, India has rallied much less than the other markets. All right. So Brazil, for example, we bought Brazil in the first week of April. From there, it is up 50%. Okay. Brazil is up 50% from the lows of March. Okay. We have Brazil. We bought a lot of oil around the teens. That's doubled. So practically every asset class is done well. Global emerging market debt has had a very good run. US investment grade bonds have had a good run. All kinds of assets have rallied. It's not just equity markets and definitely not just India. So first of all, understand the Indian rally is in line with what has happened elsewhere. In fact, it is a little bit more muted than the rest of the world. The reasons for that are very, very simple to understand. The reasons are that India went into a very harsh lockdown, okay, the harshest in the world. It has come out of the lockdown, okay, or at least in phases, while the cases are still climbing. All right, we all know that. And as long as this graph remains steeply trending upwards, we have a pressure on a healthcare system, we have pressure on the banking system, we have pressure on all kinds of support systems in the economy, which is why India has lagged the global rally by a little bit, by about 5 or 7% points. But an interesting thing has happened. Okay, this has been happening for the last 4, 5, 10 days. And in many, many markets, and we track like, dozens of markets across the world, there is now a reasonable small cap rally that has started globally. And it has started even in India. So if you see the last, I would say probably a week's time or maybe 4 or 5 days time, small caps have started outperforming the large caps, and quite significantly. Many, many stocks in the small cap space have, hit upper circuits, 5%, 10%, 20%, or whatever is allowed, which has not been seen for a very, very long time. Okay, that kind of a broad-based small cap rally has not been seen, I think, at least for a year, if not more. Because remember, small caps had a great run in 2017. They had a great run elsewhere. They had a great run in India also. And then basically in 2018, it just crashed. 2019 again crashed. 2020 again crashed. As a result of 2 years and 3 months of terrible performance by small caps, they fell roughly 55-60% from their peaks of 2007. Imagine a mainline index is down 55-60%. Now that index has started to revive. Now that is where the action is. That is where the action, again, please, with the caveat, we manage money, we manage it professionally, we manage a lot of risk management in place. Please do not just listen to this and go out and become a mad buyer of small caps. There's a very, very dangerous space. It's a very volatile space. Many people have lost more money there than people have made more money. So please do not take this as a clarion call to go and blindly buy small cap. We have bought in our PMS. We have now, as we speak right now, a 67% allocation to small and mid caps. Okay, and the balance 33% is in the large caps. Okay, so we have altered our portfolio in the last 15 days or so. But I'm sorry, do not take this as gospel for you to go very well informed, very analytical. You have all the tools to be able to do it yourself. Otherwise, please go to a professional who knows, what they're doing. So with that caveat, we see a pretty significant rally in the small caps, not just in India. I'm seeing that in Japan small caps. I'm seeing that in Chinese small caps. I'm seeing that in US small caps. We are seeing that in European small caps. That is the space where it's very much possible you can get a 10-15% index level rally. If you get a 10-15% index level rally, you're talking a very, very big move on individual stocks, which could be as much as like a 50% move, or many stocks can even double in this rally. So the space where we are bullish right now, and our portfolio just reflect that, is in the mid and small cap space, with again the caveat, dangerous space, very volatile, can collapse without a warning. We do a lot of work, so we are professionals. We have done this for a long time. We can manage it. Most investors will not be able to have those disciplines, so please do it very, very carefully. All right. So in a nutshell, large caps in India, with the possible exception of 4, 5, 6 major large caps, will not perform as much as the small caps will. So there is going to be a clear altering of the performance seesaw in India. Large caps will lag, small caps will really outperform. And that is at least our reading, our thinking, and we are positioned that way in our portfolios. All right. Overall, we think that large caps may, in some cases, even start to lag, as you have seen that the Hindustan Levers or the Asian Paints and many other FMCG companies have started to lag, underperform the markets. Okay, which always happens when people start to think that there are only 12-15 companies in India worth investing in. So buy a Nestle or a Britannia or a Lever or Asian Paints and HDFC Bank and Kotak Bank, and that's it. You have nothing else to worry about in life. Unfortunately, investing is never that simple. Things change. Trades change. And wherever something becomes so obvious, it changes. So when oil went to $5 or $8, in fact, went to negative, we tried to buy it. We were unable to buy it. We finally ended up buying at $15 or $16, $17. It has gone to $40 in exactly, April 29th. In exactly 35 days, we have made more than 100% in oil. And why? Everybody said, no, oil is over. Nobody's going to take any oil. The world traffic is over. Planes won't fly, cars won't run, anything of that sort. Whenever people start to think like that, the market forces you to be, market compels people to change their views. As it is now compelling us to change our views on small caps, it is changing our views on even the Levers and the Asian Paints of the world, where we thought we would just buy and forget. You can see they're beginning to lag, and I think they will lag in the future. The trade has moved away from these 10, 12, very loved and very fancied companies. So that in a nutshell is our strategy, our outlook. We think there is legs to the rally. It is not going to collapse tomorrow by any standards, but there are areas in the market that you need to be careful about. And one of the major areas, of course, is banks and NBFCs, where, you know, if you're very, very confident of what you're doing, please do that. But we don't have any banks and NBFCs in our portfolio. Okay, so just to be clear about it, we still think that's a problematic space, and there are better places to make money in. I don't have to play every trade in the market that goes up. One of the biggest mistakes investors do is that they want to be in every part of the market. You cannot be, all right? You need to choose with confidence that, okay, these are the areas that look good. These are the areas that might do well, but that's not for me. Banks and NBFCs belong to that category as of right now. We think there is still stress ahead for many of these players. They might get a bounce of 10-20%, many are bounced also, but we are not playing that. We are playing other places. So, for example, you know, we have played and we are still continuing to play because we saw global risk on trade coming up. I don't know, prices are going up, Brazil doing well, Russia doing well. So we bought a lot of the Indian materials players, and you can see all of them are now probably at 6-month highs. I won't name them, but you know, there are only 4 or 5 of them. So we allocated significant part of a portfolio to them, and we are riding that upwave in the materials space. Okay, so basically the industrial commodities. So small caps, industrial commodities, telecoms, broadly, those are, in our view at least, good places. Again, pick carefully, get proper advice. We are hares. We are neither bulls nor bears. We are always harish, never bullish, never bearish. We will turn. If we see things changing tomorrow, this conversation has never happened. We'll be out of it. You cannot change that fast. We will change that fast. I mean, in my investing career, I have gone from being 100% long in a particular stock to being completely short, all in the matter of one day. Single trading session. That's how quickly I can turn. Not many people can turn like that, but that's everybody's philosophy. So therefore, all that I'm saying is our views right now. We are alive to changes. We are never very fixed or rigid in our philosophies. We believe that we only know things up to a point. We don't know everything. And when there is new information that comes in, we are willing to change our mind. So we never had oil. But when oil goes to $5, $10, $15, we said, this is ridiculous. It cannot remain here. We went long oil. We are making 125% on that. But did it mean that we were so convinced of the rally that we will buy it at $80, $70, $50, $40, $10? No. Not convinced, stay away. Convinced, buy a little bit. We were, by the way, we just have 2.5% in oil. It's not that we went and bet our entire portfolio. So the point I'm trying to make is we are very nimble. We are very harish. We will turn. The other central mantra, which I want to leave you, gentlemen and ladies, if there are any on this call, with is our approach is when people call me, people message me, Twitter, etc. Sir, ek koi 10-bagger tip de do, 5-bagger tip de do, 20-bagger. And I only tell them this, that there is nobody in this world who can tell you that. It's impossible. It's impossible. Nobody can tell you before something becomes a 10-bagger that it's going to become a 10-bagger. You can only know up to a point, maybe a 50% move you can see, maybe even 100%. Anything beyond that is only your ego talking, and rather, more importantly, your luck talking, okay? But there is a way to do this, and that's exactly the way we do it. So in our data sciences approach, we have a lot of factors, like literally hundreds of factors that we analyze. And as a result of that, we come up with a certain list of stocks. You build a portfolio. We don't take more than a 5-7% bet on any one stocks, more like 2.5%. Then you will find, if you've got a carefully constructed, and I'm repeating, carefully constructed, not a random portfolio of 20-25 stocks, and you have average of 4 or 5% in every stock, you will find at the end of a certain period, maybe it's 6 months, maybe even 12 months, that maybe 5 or 7 have really gone up, maybe 50%, depending a lot on the market also, but 50%, 70%, 100%, some 1 or 2 might have even, doubled or tripled from there. Then there will be a bulk in the middle, which will be more or less around the market. Okay, so market up 20, they'll be up 25, they'll be up 15 or 18 thereabouts. And then there will be a bottom 10-20%, which inevitably you'll find laggards, because not every stock in your portfolio is going to be an outperformer. So those will be a laggards. As a process of filtration, those you need to take out, put in some next 4 or 5 better ones at that point in time. Let the winners keep running. At the end of 5 years, you might find only one out of the original 25, but that would have gone up 10 or 20 times. That is the systematic process to pick a multi-bagger. Otherwise, this whole Warren Buffett nonsense, and I'm telling you, I have a lot of respect, admiration from him, but I think it's corrupted minds by giving patently irresponsible advice that just buy 4 or 5 stocks, nurse them, and that's rubbish. That's pure luck. If you buy 5 and you get one multi-bagger out of it, it is nothing but luck. But you bought 50, you made a process, or 25. That's a systematic process to come up with, bunch of multi-baggers. It could be 100 baggers, it could be 10 baggers, 15 baggers, 5 baggers. But picking 4, 3, 2, 1, it's all nonsense. That only happens out of a fluke. Nothing more than that. Some of the best trades I have done, I would never do again as standalone trades. Because my learning over 30 days of investing is that when you buy 1 or 2, put a lot of money in it, there's a lot of stress, it can go wrong, you're down 50%, that's ridiculous. Buy a basket, buy a portfolio, take a portfolio approach to investing. So that is my final parting message in this. If you can implement it, please implement it. If you cannot, go to a professional who does it. But don't do this 1 stock, 2 stock, ye de do, multi-bagger kya hota hai? There is nobody in this world. So neither Warren Buffett knew Coke would do well, nor did Jeff Bezos know that his company would eventually become a $1 trillion company, or neither did Steve Jobs know that at one point it would become a 70 bagger. Nobody knows. All right. So if you don't know, buy a basket, let the basket itself perform and give you your multi-baggers. So that's the nutshell of what I have for you today. I'm happy to take questions.
Right. Thank you, Mr. Sharma. So the first question that we have is with regards to telecom sector. What are your views with regards to telecom? And, if you could also talk about maybe Vodafone in this context. We have seen Vodafone, growing 8 times in last 8 days. Over to you.
Also, we have telecom in our portfolio. So, by the way, we have not had telecom in our portfolio per se investment for the last 12 years. 2007 peak of the telecom market. We published 3 pieces of research. We said that this is the peak for the telecom stocks. Bharti has not seen that price till 15 days back. That was the peak. And it took 12 years to come back to that price. That's the way we do it. Okay, everything at a certain price is okay. But we will not keep saying India, a great telecom market, penetration is low, keep buying. That's all nonsense. That was already in the price then. 12 years later, it became cheap. We bought it. All right. We bought the other telecom play. We have not bought Vodafone Idea because we have certain risk parameters in our portfolio strategy. Because when you're managing people's money, you can't go out and take that much risk. Personal money, you can do a lot of crazy stuff. So yeah, we like the space. So that's the question.
Right. And what are your views with regards to auto sector?
So that's a problem area, and we have not got any autos in our portfolio right now. That's not to say it will remain a problem. For us, it is not the sector. Like I said, we don't have to play every sector, every stock that goes up. There are many stocks that we don't own that go up 50, 100%. That's okay. That's part and parcel of investing. As long as our stocks do quite well on a wide base, we are fine. Autos might have a relief rally or a bounce or something like that. So Tata Motors is valued at that. That's not for us right now. But we have an open mind. Like I said, we are always bearish. We will keep evaluating and we will change. We don't have rigid views that this is the way we want to do it and something else will never come in. No, that's not us.
Right. So apart from materials, if you have to name, few other sectors that you are really bullish upon, what would be those?
Also, we like chemicals. I have made tons of money on chemicals personally for the last 6, 7, 8 years, right from 2013, I think. We continue to like select chemical plays. We have chemicals in our portfolios. So we like pharma. We have, I think, 20-25% in pharma in our portfolios. I cannot take stock names, but yeah, we like chemicals. We like pharma sports, and we have them, to a reasonable extent in our portfolios.
Sure. So what are the risks that you see look ahead? So as you have confidently mentioned that now markets have legs to it. We have seen a broad-based rally coming in after 3 years, and this market is not going to fall overnight. But there are a lot of investors, who may have missed the rally in last 10-15 days because markets just maybe 10 days ago was at a 8800 level. I'm talking about Nifty, and it's up to 10,200 levels today. So investors have missed, and they are wanting to wait and then wanting to enter. But you confidently mentioned that markets may not fall. So what is your suggestion to those investors, and do you see any reasons, any risk factors which could actually lead to fall, because anything can happen in equity markets?
Yeah, like I said, many stocks will still fall. I don't think many of the leveraged companies have seen a bottom. But it's for each investor to take a call. Like I said, from the way we manage money, we went 100% invested on April 1st, and we have not gone into any degree of cash since then. So we remain very optimistic for the stocks that we own. For the broader markets, there are stocks that we really like, and there are areas where we are completely away from. So it's for each investor to take a call. And again, if you think you missed out the rally, you might want to participate 20-30%, and see how it goes. It's never an all or nothing thing in investing, because you'll never be able to get 100% right. But I always say this, that, at a certain level, a certain amount of investment is warranted, but choose properly, choose well. Don't blindly do things, because again, I'm reiterating, the economy has not come out of the problem. If anything, the India is still going deeper into this problem. So the areas which are directly dependent on an economic revival, which is an auto space or a banking space, are the areas which will be very, very wobbly. They might rally a bit, but they can even collapse overnight. So I would at least, that's our strategy. I'm not saying it's going to be right or 100% right to the gospel. Our strategy is stay away from those areas. There are many other areas to make money in. We are making money. There's no doubt about it.
Right. So what is your view on metals?
Metals we like. We think there is, some degree of momentum in them. And, so like I said, we have metal stocks. We loaded up on them about 3 weeks back. They're all at 6-month highs now. We are very happy with the choices. Like I mentioned, we have Brazil, which is up 50% from the time we bought in the first week of April. We have some other, metal plays across the world. So we like the space overall.
Right. So, we keep hearing about one company. I would like you to discuss about that particular company, your views. I know, it is not right to talk about stocks, but if I could request you, because a lot of investors, have and a lot of portfolios have position in that company, which is Bajaj Finance. What are your views, with regards to this particular NBFC? Because we hear it is a quality company. We understand it is a quality company, well penetrated portfolio, a company which has years of history and has created brand. But obviously now, a lot of unknown is there with regards to its unsecured lending book. There are a lot of rumors, there are a lot of research reports have also come out, but suddenly we have seen stock rallying 20% from its lows. What are your views? If investors
That's okay. Like I said, many things rally. I don't have to buy all of them. We don't have any Bajaj Finance in our portfolio. And I doubt if we are going to have it for some time. Like I said, nothing is fixed in life. There are better places in this world to make money more safely than, NBFCs and lenders. So we are avoiding them, but there's nothing permanent about it. Right now, we don't think there is adequate reason. Like I said, rally is fine. But like I said, there is risk there. Job losses are still mounting. Economy is going to be in big problems. In all those situations, banks, lenders are the worst place to be in. At some point, they will turn. That's not for us to decide. We will keep an open mind. But as of right now, that's not at least what we have in our portfolios.
So despite the fact that economy is definitely on downtrend, 2 weeks ago, we were anticipating that India, which had never ever thought to get into a negative GDP, which is what theoretically we call as a recession, we may, see that, because a lot of research reports have projected that. And still, there are no reasons for us to not believe that it may not happen. But markets have rallied. So 2 questions. One, what are your views with regards to the GDP or economic uptrend? And secondly, what are your views? Can this market rally continue to be like that, and can it make an all-time high, despite the reality being something else?
So stock market and macroeconomics are not necessarily related on a day-to-day basis. I think all of you should forget about that. Stock market is it's no longer a barometer of the economy and stuff. It's a collection of stocks. And at some point, a collection of stocks can do better than the economy, which is what we saw even, last year when the economy was still hurting and certain stocks, made pretty decent, like the FMCGs and all that. So don't mix up the two things. And it's not just about India. I'm repeating, all markets, all asset classes in the world have rallied in the last 1.5 months. India has been one of the poorer performers in the overall global rally. Okay, just to be clear, don't start thinking it's only an India rally, all right? So economies are hurting across the world, but markets have rallied, and they rally when you have a 30% single month fall, you will get a bounce back, all right? Now, does that mean markets go and make a new high? I really doubt it. But do I think there is money to be made? Of course, 100%. We are making money. Like I said, we made money in April. We are okay May. I think we're going to have a pretty decent June, given our small cap sort of outlook. So, we think there are many stocks which will make lifetime highs. They are already making highs, and they will even double, triple from here in the course of this 1 year. So, I don't think the Nifty or the Sensex go back to their old highs anytime soon. Okay, that's going to be a very, if that happens, I will say that that's a miracle. Okay, things can happen in markets. So there's no absolute yes and no's. It can happen. Do I think it is probable? I don't think it's very highly probable. Do I think there is money to be made in the market? 100%. Are we making money? Of course. Are there stocks making new highs? Yes. I mean, that's the answer for you.
So most people believe and most people convey that markets are rallying because of liquidity. You also started, with the same comments that, markets have got immense liquidity, and liquidity, is there. And we see a lot of FI buying happening. FIs have not been buying for last couple of years, but of late, over last 15 days, if we see FI figures, they have turned positive. They have reduced their shorts. But, now since you have been tracking FIs, what are your, views in this regards? Yeah.
FII flows are nothing but complete and total nonsense. It's crap. It is followed and analyzed only by idiots. It should not be followed or analyzed by anybody serious who's got even an IQ of 50. It is a complete bullshit number. It is a number that nobody, including the FIIs, can predict. It follows a certain market move. Markets start to rally. You will see monies come back in. Markets start to fall. They'll go back out. There is no predictability to FII flow. So I don't even want to waste my time answering that question. I've looked at them since 1994 or 1995 when the data started to come out. It's just all over the place. आज 5,000 crore plus, कल minus 15,000 crore, अगले हफ्ते में 50,000 crore आ जाएगा, इस 2 हफ्ते बाद 2 billion निकल जाए. क्या मतलब है इस चीज का? तो all rubbish, a waste of time. Who cares? Who's buying or who's selling does not matter in stock markets. Understand that. Markets on everybody FII ले ले चलना चाहिए. क्या nonsense की बात करते हो यार? FII ने लिया तो किसी ने बेचा ना. Somebody sold, right? Why are you not looking at someone who knows? So the point is, forget about this buy. It has no impact on stock prices. Focus on fundamentals and technicals of markets. Don't waste time looking at FII.
So, fundamentally, as this is the last question. So how do you see market rally, with regards to fundamentals? With regards to technicals, you've explained that because of liquidity, markets are rallying, markets had fallen too much. There was a 30% fall, and hence markets are rallying because global markets have rallied, hence Indian market is rallying. But, as we all are worried about the fundamentals, and now you, in your last stance, have also talked about fundamentals. So what are your views in that context?
So like I said, there are areas in the market where numbers will be good. We have a number of companies in our portfolio where we see that they will actually do well and they will benefit from this portfolio, from this current problem. But equally, there are many companies who will not come back to their original earnings numbers for a year, maybe even more. So when you say fundamentals, I'm only interested in the fundamentals of stocks that we own. I'm not interested in fundamental stocks that we don't own because of the reason why we don't own them is that we do not believe that their fundamentals are going to improve anytime soon. So like I said, if you go from zero revenue where many companies were in March and April, and you go to 50% revenue in the next month, you will see a pop in the stock prices. But for them to go back to original revenues, original profit levels is still some way down the road. So I mean, like I said, I mean, I don't have to play every stock in the market. Many stocks will rally. We are playing the ones where we know these companies will do well. And there are many companies. I said, there's many companies out there where I can easily see a 50% or 100% return in the next, 12 months time. And we own many of them in our portfolios. We are still evaluating. In June, we will have many more stocks coming into our portfolio, which we see a 20, 50, 100, 200% baggers in the next year's time. We are focused only on that. Why am I concerned about Nifty and all this? I know I'm never going to buy the Nifty. It's a waste of my time.
So one last, minute or 2 minutes, on your Super 50 portfolio. So how do you, define that in terms of your stock selection philosophy? Over to you.
So we have a very wide universe, a very wide universe, and from that we run through our systems, and we have some of the world's highest powered computers running this. I mean, the amount of money we pay, to our service provider is not funny. It's a huge amount of money. That's actually a bigger cost for us than analysts, because analysts are a waste of time. It's really computing power. And we do this across the world, not just for India. And through a lot of data with a lot of factors, a lot of indicators, we have got like literally hundreds of indicators that we watch, hundreds of factors that we analyze. Out of that, we get a list. We get a list of 50, 55, 60 positions that our systems, our AI ML systems give us. That is then analyzed by us, because then we will not accept 100% of it. We will reject 5 or 10 or 12 or 15 positions. Therefore, we end up with the best what the machine has come up with and the best that the man has come up with. You merge the two. That's the portfolio. That is what gives us the edge in this business. So a 40, 45, maybe 35 strong portfolio, which is a merger of the man plus machine model. That is our process. And the other thing they're very rigid about is risk management. Most people don't understand the value of that till you go through a March-like situation. We have understood it. I've done this personally 30 years. I've lost a lot of money not having good risk management. For me, that is bigger than finding a great stock. If I don't lose money, I will always make money. So for us, risk management is hard-coded, non-negotiable, no rationalization. At a certain price, you're out of the trade. End of the story. Once you follow a rigid database discipline, we are also bias free. We have no biases. I'm not going to come and say Kotak Bank, this Aditya Puri, great. They might be, but they're human beings. They can make mistakes. We don't get so convinced about anything that we have a hard time unconvincing ourselves. That's not us. We are more like neutral. Yeah, we have 40 stocks. Something goes wrong, we'll be out of it. But I'm not going to come out and pound the table and say, great management, great promoter, ethical guy, clean guy. What nonsense is this? Many ethical guys also make mistakes. Okay. So we are not high, it's also very rigid philosophies. We are very practical. I'm a practical man. I'm willing to change my view. Things change. When I become too rigid, when I start to support a stock so much, things change. I will not be able to change. And that is where biggest investment mistakes happen. Warren Buffett should have sold his Coca-Cola position decades back. But because he was so publicly wedded to Coke, he just could not detach himself. How can I sell off something I've told people that defines my investing style? That's not us. That's not our style. We are neutral, unbiased, bias-free, no stories. It's a game of making money. We make money, period.
Phenomenal. So this is the last question. And, I will really thank you before I ask this question. It has been a really insightful session. You have covered most of the concerns and queries. And in fact, the question which I'm going to ask, I think more or less this is also covered. But, this question pertains to the fact that, in last 3 years, most of the portfolios have not been able to beat the benchmark. And in fact, they have delivered, I would say, lower than, maybe debt returns or even FD returns. How can your portfolio within equity market perform differently?
I'll tell you, it's very simple. First of all, the reasons why they don't do well, and I think we have explained the reason, they have no concept of risk management. So Bajaj Finance, 4,000 rupees mein great buy. 3,000 rupees bare, to abhi to kya bacha? What is the problem? Greater buy, 2,000 rupees super great buy. That is ridiculous. It is criminal neglect of basic tenets of doing anything. You should have been out of Bajaj Finance at 3,000 rupees, maybe 2,800 rupees, something like that. What are you doing here, sitting at 1,800 rupees and justifying why your decision to be remaining long for 2,000 rupees was right? So no risk management. Second, they run very concentrated portfolios. Everybody at 40 to 60% in financials. That's ridiculous. I mean, again, totally irresponsible approach. And the third is very, very simple. That when, as I was mentioning, when you tend to become so emotional about your holdings that you start to write essays about them, you start to interview those managements, you start to meet with them, start to hang with them. Hey, tomorrow, if the time comes to change, you will not be able to change because you've gone out publicly defending, supporting those companies, those businesses, those managements, so that tomorrow your ego, your biases will tell you, how can I now change? We have none of those problems. Therefore, we find the best, our Super 50 is the collection of best 50 stocks at any point in time in India. And you will see, we will deliver returns far in excess of what anybody else has delivered or will deliver. And we'll obviously beat the markets hands down without any doubt, because a lot of it is common sense. But the problem is people don't follow common sense. People want to follow stories. We don't follow stories. So our man plus machine model rids us of biases, gives us a lot of rigor, very strong risk management, not over concentrated holdings. When you put everything together in a systematic model, we will beat the daylights out of this market without any doubt. We already are. You can already see the data as we speak right now, and this will continue.
Right. So this is, one subsequent question that comes to my mind. I really want to take your permission before I ask this question, if you allow. As you have mentioned that you have a Super 50 portfolio where data plus machine, so it kind of sounds very different from the entire gamut of mutual funds and PMS products, because every fund manager talks about buy and hold, and those products, I would say, sell better, or those products are demanded more, which show more resilience, which show less churning. And your style of managing your Super 50 portfolio is kind of changing your stance very quickly, like you have mentioned with various examples, right? So is that so? How would you explain about a churning of your portfolio?
No, there's no churning. Like I said, we have a quarterly rebalance, the very systematic, very, very systematic approach. Every quarter, we will look at all factors, all data, okay? Our systems will come up with a list of the same 50, 60 stocks. Out of that, we think and we believe and we have seen nearly 70, 80% are repeated. Maybe even more are repeated. They continue. But some, like I said, in any portfolio construction, are you going to get 100% winners? No way. You then wean out the losers. The numbers have not come out, margin contraction, factors have changed. There can be many, many reasons. So the system will eject them and they'll be replaced with a new set of better performers. It's like a cricket team. Are you going to have the same cricket team whether you're winning or losing? वही 16 प्लेयर ही रहने चाहिए, मतलब आज ले लिया वो 16 प्लेयर तो लाइफ लॉन्ग 16 प्लेयर चलेंगे क्या? No, you will find 7, 8 are good guys. They're performing series after series, game after. But the 2, 3 will keep changing. They have to change. That is the order of nature. How can you say that I decide cricket team yahi 16, irrespective of new talent coming in, the old guys getting tired, old, not performing? So if products like that who say कि आज ले लिया और lifelong भूल जाओ, sorry boss, that's not us. We have an open mind. Maybe 70, 80% of the core team will remain, but 20, 30% will change because new things happen. Would you have bought Bharti 6 months back? No. Would you have bought Reliance? No. Why do you want to buy Reliance today? If I don't change today, I'll be a fossil. So that's not us. So if you want to buy a portfolio or go to a fund manager who's lazy, कि आज 10 stock ले लो और भूल जाओ, sorry, that is not us. We might have 8 out of those 10, but the 2 will keep changing. It has to change. And believe me, I've become very rich in this game doing that. I know a bit about it. All right. I've done this. I started the video at 10,000 rupees. And in 1996, I was India's top 5 taxpayers, personal, individual. In year 2000, when I was merely 35 years of age, Okay, I paid more tax than Salman Khan and Shah Rukh Khan. So I know a bit about this game. I know a bit about making money. I don't talk out of thin air. You need to remain nimble and flexible, even while retaining the core part of your portfolio. Keep your eyes open for a better performer, better player, better fast bowler, better batsman to come in. Take out the old ones. What is the problem?
So, while, you have been talking, so, I think everybody's really liking it. So, we have all the participants still there and more questions are coming in. We'll take one more question. So out of Bharti and Reliance, if you were to choose one stock, which will you choose? This is the last question and then we will wind it up.
Why do you need to choose? I don't understand. What's the point of choosing? We anyway never have more than 5% in a certain stock. Why do I need to choose? Why can I not have both?
So if you were to give weights, which will you give higher weight?
Oh, see, again, now that's becoming too micro. This forum is not about investment strategy and a detailed presentation on what weight and how you should weight and what is a volatility adjusted weight, because there is a lot of science in position sizing. It is not a blind thing that I'll keep 5% or 2.5%. There is a reason why something is 2.5%. There's a reason why something is 4 or 5. But this is not the forum for that. What I'm saying is, why do you need to choose? As I've said, our approach is a portfolio approach and not to buy one stock and put all my belief in that one stock. That might be there for some other fund managers and mutual fund managers. By all means, go to them. You will see after 3 years whose numbers are better. You've seen in 3 months whose numbers are better. And as I said, I'm not a kid who doesn't know what he's talking about. This business has given me more wealth than probably I deserve. And I did not start with some Bhagwan ka Vardhan or anything. We went in there as a 25-year-old kid, learned, made mistakes, and this is 30 years of that learning talking. That's what it is. So don't get wedded to Bharti or Reliance. If the sector looks good, buy both of them. It's like in the 90s. Why did you need to buy only Infosys? You could have bought the 4 or 5 listed stocks. You would have made, with lower risk, the same level of returns as the whole sector. It's a much more sensible approach.
Thank you so much, Mr. Sharma. It has been really pleasure having you here, and we would again, connect with you maybe in due course.
Sure.
Thank you so much. Thank you.
Thank you very much.